Now let's look at the double declining balance method. And we will be doing the depreciation for the same asset. Now, under the double declining balance method, all we do is we first focus on the rate at which the balance is declining. It's double declining balance. So we double the straight line rate. Now, assuming we were told it's 150% declining balance, then we would have done 150% of the straight line rate. Now, 150% of 20% is 30%. But the question is double declining balance method. So we double the straight line rate, we get 0.4, which is 40%. Now, with the double declining balance method, and indeed all the accelerated methods, we do not deduct the salvage value upfront. Again, we do not deduct the salvage value upfront. So there is a clear difference between the straight line method and the accelerated depreciation methods, such as the double declining balance, 150% declining balance methods. And the difference again is that we do not deduct the salvage or residual value upfront. So let's look at the double declining balance method. We start off with the asset cost of $65,000 at the beginning of year one. Now, at the end of the year, the asset would have depreciated, but by how much? Double declining balance method. So depreciated by 40%. So let's do 40% of the asset value or the balance in the account, and 40% is 26,000, meaning that if the asset has declined or depreciated by 26,000, we are only left with 39,000. Now, this ending balance becomes the beginning balance in the second year, because this is like December 31 and then January 1. Now, if the beginning balance is 39,000 and it is depreciating by 40%, the depreciation in the second year will be 15,600, which means we'll be left with 23,400, which becomes the beginning balance in the third year. 40% of that is 9,360. Ending balance becomes 14,040. Fourth year, we have 14,040 as the balance. It declines or depreciates by 40% again. So the depreciation expense is 5,616 and the ending balance is 8,424. Now, if the asset depreciates by 40% in the fifth year, depreciation expense will be 40% of 8,424, and that will give us 3,369.6. And the ending balance at the end of the fifth year will be 8,424 minus the depreciation expense, and what we would have is 5,054.4. Now, this is unacceptable because our salvage value at the end of the fifth year should be 5,000. So what this implies is that we need to do some approximation in the final year. So what we do is we work backwards let the salvage value be 5,000 as required, and calculate the depreciation for the 5th year, which is an approximation. And what we'll do is 8424 minus 5,000, and the depreciation for the 5th year should rather be 3,424. So note that using the accelerated depreciation methods like double declining balance methods, we would have to do an approximation in the 5th year to ensure that we get the salvage value. Also note that compared to the straight line method, in the early years, depreciation is higher. First and second year, depreciation is higher. Then in the 3rd, 4th, and 5th year, depreciation is lower than the 12,000 for the straight line. So this method accelerates depreciation in the early years compared to the straight line method. And that is why we refer to it as the accelerated depreciation method. Now let's move on to the next question, which is on inventories. Now again, inventories is an operating asset. And in this question, Montana Great Outdoors had the following inventory in 2012. The company uses the FIFO method of accounting for inventory, which means the assumption is that the first inventory in is the first out. The first purchased is the first sold. And we are provided with some information about the inventory transactions during 2012. Beginning inventory, August 1, 2011 is 120 units purchased at a cost of 19.50 each. Now, other purchases came in at varying costs, 300 at 19.0, 50 at 20, and then 120 at 20.30. At the end of the period, 130 units remained. Now, the company's ending inventory and the cost of goods sold for fiscal 2012 can be determined using the following formula. And this formula is very intuitive. We don't need to memorize it. Beginning inventory, that's the inventory in storage at the beginning of the period, plus the purchases that came in, less what went out or was sold, should give us what remains at the end of the period, which is ending inventory. We can flip the formula and have beginning inventory plus purchases less what remained in inventory should be equal to what was sold, cost of goods sold. Now, on this basis, we can determine the number of units sold using the above formula. And we start off with the beginning units, 120, which is right here, plus the purchases. Now, the purchases were 350 and 120. So 350, 120, minus the ending inventory, which is 130. That gives us 460 units being sold. With this information, we can determine our cost of goods sold and our ending inventory under FIFO, first in, first out. Now, how do we come up with the ending inventory? 130 units remain in ending inventory. If the first in is the first to be sold, then what remains in ending inventory will be the last. So what do? We work our way from the bottom for the ending inventory. So we can calculate ending inventory directly as follows. 120 units, the last that came in, is what is remaining at 20.30. That's right here. And we multiply that and we get 2,436. But recall that the ending inventory is 130 units. So we need 10 more units. So this is in ending inventory. We need 10 units from here. And the cost of that purchase was 20 each. So we'll have 10 at 20, we have 200. And the total value of the ending inventory, what is remaining, is 2,636. Now we can determine ending inventory by working the problem differently, using cost of goods sold and subtracting cost of goods sold from here. So let's come up with that. And to do that, let's look at the calculation for cost of goods sold. Now recall that 460 units were sold, and the first in is the first out. The first is 120 units and the cost is 19.50. So that's right here. Now next is 300 units at 19. So that's what we have here. Now bear in mind that 460 units were sold. So together we have 420 units. We're left with 40 units to get the 460. So the last 40 units would come from the next layer of inventory, which is at 20 each. So 40 by 20, and we combine all to get 8,840 as the cost of the goods sold. Now if cost of goods sold is 8,840, we can plug it into the above formula to get ending inventory. Beginning inventory is given to us as 120 at 19.50. These are the purchases. We have all the information provided, minus the cost of goods sold we've calculated as 8,840. We do the calculation of all of this and we get 2,636 as before. So this brings us to the end of our analysis of operating assets questions.